What if the biggest factor affecting your next stock investment isn't just earnings or revenue or, a company's actual products? What if the singular force dictating whether your portfolio grows or shrinks is actually politics?
It is a dynamic that completely upends the traditional playbook. I mean,
Oh.
we are all trained to look inward at the company, right? But right now, the most powerful forces are entirely external.
Because normally, you open up a 10K file and you look at a balance sheet, you read the income statement, and you think, okay, I understand the mechanics of this business.
Right. You know their margins, you know their debt levels.
Exactly. But in today's market, and we are looking at this landscape as of August 11th, 2026, Washington can alter the fundamental economics of an entire global industry with just a single stroke of a pen.
Oh, absolutely.
I mean, we are talking about a new tariff or an unexpected export restriction, maybe a sudden defense appropriation, a shift in energy policy, or, an escalation in relations with China or Iran.
Which creates a deeply treacherous environment for the everyday investor. Because think about it, you can have a company report absolutely stellar earnings, just blowing past every Wall Street estimate.
Yeah.
And then you watch the stock violently sell off because institutional investors are suddenly paralyzed by, like, a regulatory rumor out of D.C.
Right, and I've seen the exact opposite happen too, where a company posts totally mediocre, middle-of-the-road numbers, management gives a really lukewarm forward guidance, and suddenly the stock surges 20% in a week.
Yeah, just because a government agency announced billions of dollars in new infrastructure spending that happens to benefit their specific sector.
Exactly. The fundamental math suddenly takes a backseat to the geopolitical narrative. And if you are managing your own money, staring at your brokerage account, that disconnect is incredibly frustrating. It feels like the market is irrational.
Well, the market isn't irrational,
Sure.
but its pricing mechanisms are shifting. And that brings us to the mission of today's deep dive. We are taking 5 major American globally dominant companies and putting them under the microscope to ask a really brutal practical question. Based on the environment we are in right now, should you be buying them, holding them, waiting for a better price, or just selling them entirely?
And we are analyzing NVIDIA, AMD, Apple, ExxonMobil, and Lockheed Martin today.
But we aren't just doing a standard earnings review. Reading off profit margins is missing the forest for the trees.
Yeah, we are evaluating each of these companies through a very specific 4-pillar framework designed for our SmartMoney USA format.
Right, so pillar 1 is the business fundamentals. That's the raw mathematical reality of their operations.
Pillar 2 is the political environment, the changing rules of the global game.
Pillar 3 is the technical chart, how the collective market is actively pricing the asset in real time.
And pillar 4, which I actually believe is the most crucial, is investor psychology.
Oh, without a doubt. If you strip everything else away, the single biggest mistake you can make in the market isn't misreading a cash flow statement. It is misunderstanding yourself.
Wow, yeah.
It is falling into the behavioral traps, the biases, the panic, the euphoria that the market sets for you every single day.
So we are going to act as your guides through this framework. Let's jump right into the deep end with the absolute behemoth of the modern market, NVIDIA.
Yeah, the big one.
This is the clearest example I can think of where bleeding-edge technology, geopolitical gravity, and raw investor psychology just violently collide.
It really is a perfect storm.
Let's start with the current snapshot. As of August 11, NVIDIA is trading around $217.45 a share.
Right.
But to really grasp what is happening under the hood, you have to look at the sheer violence of its recent price action.
The volatility is just staggering for a company with this kind of market capitalization. I mean, at the end of June, NVIDIA was trading around $195.
Okay.
Then it catches a massive bid, shoots up above 210 in July. And suddenly the momentum breaks and it drops all the way back to around 190 near the end of July. Then early August rolls around. It climbs all the way above 220 before pulling back to where we are now, settling around that 217 mark.
I mean, a $30 swing on a company of this size translates to hundreds of billions of dollars in market value being created and destroyed in a matter of weeks.
Exactly.
To me, that kind of price action tells a very specific story about institutional anxiety. The long-term structural story of AI feels undeniably powerful, but big money is actively, aggressively fighting over what that is actually worth in the short term.
Yeah, there is a brutal tug of war between the undeniable fundamental data and the looming external risks.
Let's anchor this in the fundamental data, because the fiscal Q1 2027 numbers for NVIDIA, they honestly read like a misprint to me.
They do. We are looking at $81.6 billion in quarterly revenue.
Wait, just to pause there, $81.6 billion in a single quarter?
In one quarter, yeah.
That is an increase of 85% from a year earlier. That kind of top-line growth at that massive scale breaks most financial modeling software.
And the underlying segments are even more intense. Data center revenue reached $75.2 billion, which is up 92% year over year.
Unbelievable.
Net income came in at $58.3 billion. They generated so much cash, they authorized another $80 billion in share repurchases.
Okay, but the metric that truly defies industrial logic to me is the gross margin, approximately 75%.
Yeah, that's the magic number.
I really want to push on that margin because it just doesn't make sense to me. I understand how a software company like a Microsoft or an Adobe gets a 75 or 80% gross margin.
For sure, yeah.
Because once you write the code, the cost of distributing the millionth copy is essentially zero, right?
Right, the marginal cost is tiny.
But NVIDIA makes physical hardware. They make tangible, highly complex silicon chips that require raw materials, incredibly expensive manufacturing facilities at TSMC in Taiwan, and complex packaging.
They do.
How does a hardware company maintain a software-like 75% gross margin at this astronomical scale?
So to unpack that margin, we have to look really closely at the underlying economics of this specific AI infrastructure boom, and specifically the manufacturing bottleneck.
Okay, bottlenecks.
You mentioned TSMC, Taiwan Semiconductor Manufacturing Company. They actually fabricate the chips. But the real bottleneck isn't just printing the silicon.
What is it then?
It's a process called CoWoS, or chip on wafer on substrate. It is the highly complex packaging required to stack these advanced memory and processor components together so they can communicate at lightning speed.
So the physical supply chain is structurally constrained. There are only so many of these chips that can physically be produced in a given quarter, regardless of how much money buyers throw at the problem.
Exactly. And that scarcity collides with unprecedented demand. I mean, NVIDIA is not operating in a normal supply and demand environment. They're effectively the toll booth on the only highway to artificial intelligence.
The only highway.
Right. The buyers here are the hyperscalers, massive cloud providers like Microsoft, Google, Meta, Amazon. And these companies are locked in an existential arms race.
Yeah, you see it in the headlines every day.
If Meta doesn't build out a massive cluster to train their next large language model, they fear Google will beat them to it. So they are authorizing tens of billions of dollars in capital expenditures for data centers.
And when they go to buy the compute power for those data centers, they don't have a menu of a dozen equal options. My understanding is that the hardware itself is only half the story. The real moat is CUDA, right?
CUDA is the critical mechanism here. It stands for Compute Unified Device Architecture. It is the software layer that NVIDIA developed nearly 2 decades ago.
2 decades ago? Wow.
Yeah, it allows developers to talk directly to the GPU for general-purpose computing. Because NVIDIA seeded this software into universities and research labs years ago, an entire generation of AI researchers built their models exclusively on CUDA.
So it's basically like the iOS of artificial intelligence. If you are a developer, all your tools, all your libraries, all your previous work is built in this specific ecosystem.
Exactly.
You can't just buy a cheaper chip from a competitor and copy-paste your code over. It won't work optimally.
The switching costs are astronomically high. So NVIDIA have created a captive ecosystem. When a hyperscaler builds a billion-dollar data center, the value creation of having it run smoothly on the industry-standard software far outweighs the cost of the hardware itself.
Which explains the margin.
Right. NVIDIA captures the lion's share of that economic value creation. That 75% gross margin reflects a market where buyers care infinitely more about securing the hardware allocation today than they care about negotiating a 10% discount.
Okay, so Pillar 1, the fundamentals, is essentially flawless. The business is an absolute cash printing machine with a software-like moat wrapping around a physical hardware monopoly.
Totally.
But this is where Pillar 2, politics, enters the story and throws a massive wrench into the machine.
Yeah.
Because NVIDIA isn't just selling graphics cards to teenagers building gaming PCs anymore.
Not at all.
They are selling what governments now view as the most strategically important national security assets on the planet.
Which completely changes the regulatory oversight of their business. Yeah. When you are selling advanced AI compute power that can simulate weather patterns, discover new pharmaceuticals, or crucially, model advanced weapons systems and conduct mass surveillance, Well, Washington cares deeply about where those chips are physically going.
Right. And the U.S. government has repeatedly used export controls to restrict these advanced AI chips from reaching China. I really want to unpack the mechanics of this because it creates a bizarre paradox for NVIDIA as a business.
It does.
On one hand, China represents a massive, technologically hungry market with deep pockets and a mandate to dominate AI.
Right.
On the other hand, selling your highest margin, most advanced products into that market directly violates U.S. national security policy regarding technological supremacy.
The mechanics of these export controls are highly granular, too. The Bureau of Industry and Security in the U.S. doesn't just say, don't sell to China.
Right, they get specific.
They establish specific mathematical thresholds. They regulate the maximum processing speed, usually measured in teraflops, and the interconnect bandwidth, how fast the chips can talk to each other.
Okay.
The policy objective is highly targeted. They want to slow down foreign military modernization by depriving them of the compute power necessary to train frontier AI models.
But for NVIDIA, the economic impact of that foreign policy is immediate. If I'm an investor looking at the Q2 guidance NVIDIA just put out, there was a massive red flag.
Yeah.
Or maybe not a red flag, but a stark reality check. When they provided their forward guidance, they explicitly stated that their forecast did not assume data center compute revenue from China.
That is a staggering admission for a global tech company, and it highlights why the political pillar is so vital. It forces any serious investor to separate the macroeconomic trend from the geopolitical reality.
Exactly.
You are no longer just asking one question when you model NVIDIA's future earnings. You're asking two entirely different questions.
Right, because question one is the fundamental question. How much AI infrastructure is the entire world going to build over the next 5 to 10 years? The answer is likely trillions of dollars.
Trillions, yeah.
But question two is the political constraint. How much of that total addressable market is NVIDIA legally permitted to serve?
The total addressable market and the legally serviceable market are diverging. And this gap between the two is where our fourth pillar, investor psychology, becomes the dominant force driving the stock's volatility.
It's all about the psychology.
Because despite this massive structural geopolitical headwind, NVIDIA has become the ultimate FOMO stock for the retail and institutional investor alike. Fear of missing out.
Let's dissect that psychology. The human brain is just a pattern recognition machine. And for the last 2 years, the pattern it recognizes is very simple. NVIDIA goes up.
Up and to the right.
I look at my portfolio, I read the headlines. Every day, AI is dominating the news. I see the 85% revenue growth. I see Mark Zuckerberg announcing another $10 billion in spending on chips. I see NVIDIA completely dominating the market share. The psychological trap snaps shut. My brain forms a very dangerous conclusion. Everyone is making generational wealth on NVIDIA. Therefore, I must buy NVIDIA at whatever price it's trading at today.
It is herd behavior in its purest, most biological form. It feels safer to be running with the herd, even if the herd is charging toward a valuation cliff, than to stand alone and miss out.
Yeah.
But successful investing requires fighting that innate biological instinct. You have to force yourself to ask the counterintuitive question, not just, is NVIDIA a revolutionary company? We know it is.
Obviously.
The question is, what future reality is already priced into this $217 stock?
That concept of priced in is something I struggle with, and I think a lot of listeners do too. If a fundamentally fantastic, world-changing company is executing perfectly, how can it be a bad investment?
Because the market is a discounting mechanism. You aren't buying past performance, you are buying a claim on future cash flows.
Right.
If the current stock price mathematically requires NVIDIA to not only capture 95% of the global market for the next decade, but also assumes that gross margins will never compress, competitors will never emerge, and geopolitical tensions with China will magically evaporate.
Which is impossible.
Exactly. Then you are paying for absolute perfection in a deeply imperfect world. If the company delivers anything less than perfection, even if it's still incredible growth, the stock will correct violently.
Which brings us to the technical chart, our third pillar, to see how this psychological battle between FOMO and valuation anxiety is actually printing on the screen. We mentioned the recent extreme volatility.
You did.
When you look at the daily chart, it shows incredibly strong historical momentum, but it feels like it is hitting a ceiling. There is very heavy resistance in the low to mid 220s. We saw it reach roughly $224.76 earlier in August before getting firmly rejected by sellers and pulling back.
The technical battleground here is very clearly defined by the market participants. The important short-term pivot area to watch is right where it is hovering now, around the 216 to 218 region.
Okay.
Below that, the critical floor, the line in the sand for the bulls, is roughly 210.
So what are the specific mechanical scenarios we should be watching for over the next few weeks?
Well, if NVIDIA can find its footing here, push up, and decisively regain and hold that 223 to 225 area on strong, confirmed institutional volume, that is the collective market telling you the bullish trend is reasserting itself.
Meaning big money is buying again.
It means big money is wanting to absorb the China geopolitical risk and pay these higher multiples. However, if the stock rolls over and decisively loses that 210 area on high volume, the psychology immediately shifts.
FOMO turns to panic.
Exactly. The FOMO turns into fear of capital loss, momentum algorithms start selling, and the market could start testing significantly lower support levels to find a valuation it actually feels comfortable with.
So synthesizing all four pillars. The astonishing 81 billion fundamental reality, the very real China export control politics, the 210 to 225 technical range, and the manic FOMO psychology. What is the final verdict on NVIDIA for the SmartMoney USA framework?
The verdict here is BY on weakness. Rather than chasing the vertical moves, you have to acknowledge the duality of the situation.
Right.
The business operations are exceptional. The AI infrastructure build-out is a highly durable, multi-year trend. But the political risk of serving global markets is structural, and the valuation risk of incredibly high expectations is dangerous. You want to own this asset, but you must demand a price that compensates you for those risks.
The primary takeaway here is that you cannot assume a great company is immune to having a bad stock price. If the market's expectations outpace the legal reality of what Washington allows them to sell, the stock will correct no matter how powerful those GPUs are.
That concept transitions us perfectly to the next asset in our framework. We just looked at what happens when a company tries to maintain absolute dominance under the weight of geopolitical gravity. But the psychology changes completely when you are the underdog.
Which brings us to AMD. Advanced Micro Devices, NVIDIA's primary American challenger in the AI hardware space. And you are right, the psychology here isn't about maintaining a 90% market share. It's about the intoxicating possibility of simply catching up.
In financial markets, the difference between pricing dominance and pricing catching up creates vastly different trading behaviors and distinct risks for retail investors.
Let's ground this in the current data. The latest available market snapshot puts AMD around $474 a share, and the volatility we just discussed with NVIDIA. That looks like a gentle boat ride compared to the absolute roller coaster AMD has been on over the past few months.
Oh, the chart is practically vertical in both directions. In May, AMD was trading around 414. Then it caught an absolute updraft of momentum, rocketing above 500 and actually reaching roughly 580 during the peak of this recent cycle.
I mean, a move from 414 to 580 in that short a time frame is massive, but it didn't hold.
Not at all. It experienced a severe, rapid correction, plunging all the way back down to this current 474 level.
Wow.
When you see a massive, large-cap technology company violently swinging 40% in a matter of weeks, it tells you something critical about the shareholder base. Investors are not treating AMD like a mature, stable semiconductor manufacturer with a diversified revenue stream. They are treating it like a highly leveraged call option on AI growth.
Let's look at the fundamentals to see if the underlying business justifies this kind of wild ride. For the first quarter of 2026, AMD reported approximately $10.3 billion in revenue. Their gross margin is sitting around 53%. And crucially, management noted on their earnings call that the data center division has now become the primary driver of both revenue and earnings growth, overtaking their legacy PC and gaming segments.
That pivot to the data center is the foundation of the entire bull case for AMD. The economic mechanism of being a challenger in a rapidly expanding, exponentially growing market is highly favorable.
Because they don't actually need to beat NVIDIA to be a wildly successful investment, right? If NVIDIA is Coke, AMD just needs to be a profitable Pepsi.
The math is incredibly forgiving for a challenger in an expanding total addressable market. AMD does not need to destroy NVIDIA. They don't even need to convince existing NVIDIA customers to rip out their current servers and replace them.
Which is hard to do.
Very hard. But the overall pie of the AI computing market is exploding so rapidly that if AMD simply captures a slightly larger percentage of the new growth, the new data centers being built next year, that alone justifies immense revenue expansion.
So just taking a slice of the new pie.
Exactly. If the global market for AI chips grows from $100 billion to $1 trillion, taking your market share from 5% to 10% is a life-changing amount of capital flowing to your bottom line.
They introduced the MI300X chip to compete directly, and the hardware specs are legitimately impressive. But the fundamentals, $10 billion in revenue, 53% margin. While strong, they are literally a fraction of NVIDIA's $81 billion and 75% margin.
Fraction.
Yet, investors pile into AMD at these massive valuations. This exposes the psychological trap of the challenger. I want to unpack this deeply because I see this happen in every major technological shift, from the early internet to electric vehicles.
It is a classic narrative trap. The market loves an underdog story. But more specifically, the market is obsessed with finding the next big thing.
The next big thing, yeah.
When one company utterly dominates a sector and its stock price has already gone up 500%, retail investors inherently start asking, who is the cheaper alternative?
It's the desperate search for the next NVIDIA. Investors missed the move in NVIDIA when it was cheap. They look at AMD and their brain tells them, oh, this is my second chance. I missed the first rocket ship. But if AMD can just replicate a fraction of NVIDIA's success, this stock will go to the moon, and I'm getting in early.
And the moment AMD releases a credible alternative chip, investors rush in. They aren't buying based on the discounted cash flows of that specific chip's projected sales. They are buying based on the imagination of what the company could become if everything goes perfectly.
Pure imagination.
That collective imagination creates enormous, often toxic expectations. And as we know, unbridled expectations can be far more dangerous to your portfolio than bad fundamentals.
Because reality eventually sets in. I want to talk about the reality of execution. We mentioned CUDA earlier, NVIDIA's software moat. AMD has its own open-source alternative called ROCm. But convincing an entire industry of developers to learn a new software stack, debug it, and trust it with billion-dollar training runs, that is a monumental task.
Execution risk is paramount here. But it's compounded by the fact that AMD faces the exact same pillar, two political headwinds that NVIDIA faces. This is a crucial point that retail investors often overlook when searching for alternatives.
Right. The U.S. government doesn't regulate the corporate logo. They regulate the technology itself. Advanced AI chips are strategically important regardless of whether they are painted green for NVIDIA or red for AMD.
Exactly.
The exact same U.S.-China technology restrictions, the same teraflop thresholds that limit NVIDIA's serviceable market, apply entirely to AMD.
So if you are buying AMD at 500 or 580, you're demanding that the company thread a nearly impossible needle. They have two massive independent variables they must solve perfectly.
Three variables. Okay.
First, technological execution. They have to actually design, manufacture, and deliver hardware and software that can genuinely rival NVIDIA's entrenched ecosystem and convince customers to switch. Second, they need favorable Washington policy, or at least a geopolitical environment that doesn't further restrict their total addressable market just as they are ramping up production.
It is a high-wire act without a net. And this brings us back to the technical context of that wild chart. When you look at a stock that moves vertically from 414 to 580 and then breaks all the way back down to 474, you have to be incredibly careful about the psychological flaw known as recency bias.
Yes, recency bias is huge here.
I look at that chart and my brain immediately says it was 580 a few weeks ago, it's on sale at 474, it's inevitably going back up to 600. I have to fight the urge to buy the dip blindly. Is that recency bias at play?
That is the exact definition of the trap. Recency bias is the human cognitive tendency to assume that whatever just happened in the recent past will indefinitely continue to happen in the future.
Right.
Investors look at a stock that recently moved from 400 to 500, and their brain intuitively extrapolates the line on the graph. It went up $100 last month. It will naturally go up $100 next month.
But the stock market isn't a physics equation where an object in motion stays in motion forever.
Price momentum does not operate in a vacuum. A stock that has already risen dramatically has already priced in a massive amount of future success. The mechanics of valuation dictate that moving from 500 to 600 requires significantly stronger fundamental developments than the move from 400 to 500 required.
The air gets thinner.
Much thinner. The air gets much thinner the higher you climb. You need progressively stronger earnings, progressively better margins, progressively wider customer adoption, and a progressively clearer political runway just to maintain the 580 price tag, let alone drive it higher.
Yeah.
The fact that momentum broke and the stock plummeted back to 474 tells us the institutional market is aggressively reassessing those exact probabilities.
So taking into account the powerful challenger narrative, the massive chart volatility, the reality of China export controls, and the threat of retail recency bias, what is the final verdict on AMD in this framework?
The verdict here is to hold or buy only on confirmed strength or a controlled pullback.
Meaning, do not try to catch the falling knife and definitely do not buy it just because it looks cheaper than it was last month.
Precisely. You have to like the long-term business opportunity. The exposure to the AI infrastructure build-out is a massive generational tailwind. But the takeaway here is strict emotional discipline.
Discipline.
You do not buy a stock simply because of a compelling underdog narrative or because other investors believe it magically holds the title of the next NVIDIA. You must demand an entry price that mathematically accounts for the immense execution risk they face.
I love how that highlights the difference between a good story and a good investment. Now, we've just looked at how Washington can freeze a company out of a foreign market by stopping what goes out, export controls, but I want to pivot the theme entirely. What happens when Washington uses the political blade to tax what comes in? Number 3 on our list is Apple.
This is where the framework gets incredibly practical for the everyday economy, because Apple is not primarily an enterprise AI infrastructure play. It is the ultimate global consumer technology company.
It really is.
And its biggest fundamental strengths might actually be something that gets overlooked in all the current AI hype, pure, unadulterated pricing power.
Let's look at the snapshot. Apple is currently trading around $304.89. And similar to our semiconductor stocks, it has seen a significant, noticeable pullback. It was trading above 340 in late July before falling back to this 305 level over the last few weeks.
And that decline requires deep structural analysis because it is certainly not being driven by a sudden collapse in their underlying business operations. I mean, the Q3 2026 revenue numbers just came in at roughly $109 billion.
Let's just sit with that number for a second. $109 billion in a single quarter. It's difficult to even conceptualize that much money changing hands for iPhones, Macs, iPads, and services in a 90-day window.
It is a consumer behemoth, unlike anything in economic history. And the reason they can consistently generate that kind of revenue is their structural advantage. They have an enormous, highly sticky installed base.
Sticky is the word.
Yeah, once you have the iPhone, the Apple Watch, the Mac, and your photos are in iCloud, the friction of leaving that ecosystem for an Android device is immense. That locked-in ecosystem combined with a premium customer demographic gives Apple a level of pricing power and margin protection that most hardware manufacturers can only dream of.
But if the ecosystem is that inescapable and the customer base is that loyal, why is the stock pulling back from 340 to 304? This brings us to the political variable, and as I mentioned, it is a completely different mechanism than the export controls hitting the chip makers. For Apple, the geopolitical sword hanging over its head is trade policy, specifically the threat of broad tariffs.
Apple's supply chain is a marvel of modern logistics, but it is deeply inextricably international. We think of Apple as an American company, but the physical reality of the iPhone is profoundly global.
Right.
Components are sourced from dozens of countries, displays from Samsung in South Korea, glass from Corning, various sensors from Europe and Japan. Final assembly largely happens in massive facilities run by companies like Foxconn in Zhengzhou, China, and the finished products are then shipped worldwide.
That level of globalization was the engine of their profitability for the last 20 years. But suddenly, it's a vulnerability. Tariffs, trade restrictions, and bilateral trade wars can directly impact their manufacturing costs, their component pricing, and ultimately, their sacred gross margins.
Exactly.
I really want to break down the actual economics of a tariff here because this is a point of massive confusion for the general public and even for some folks managing their own portfolios.
Oh, there is so much confusion on this.
When the U.S. government slaps a 10% or 25% tariff on electronics imported from a foreign country, a lot of people assume that the foreign country's government is literally writing a check to the U.S. Treasury.
Which is fundamentally economically incorrect.
Yeah.
A tariff is simply a tax placed on an imported good at the border. The foreign government doesn't pay a dime of it.
Right.
The foreign manufacturer doesn't directly pay it to the U.S. government. The burden of that tax hits the domestic side of the equation. It falls on the American importers, the domestic distributors, the retail companies, and ultimately the end consumer.
It's a friction tax on the supply chain. So, if a new tariff policy is enacted in Washington that significantly raises the cost of importing assembled iPhones or crucial components from overseas, Apple is immediately faced with three very painful, very mechanical choices. Let's walk through them because this is how you model the stock's downside risk.
Choice number one, Apple absorbs the cost.
Yeah.
They keep the retail price of the iPhone exactly the same, say $1,200. But because their cost of goods sold just went up due to the tariff tax, their profit margin shrinks.
Which Wall Street hates.
For a company valued heavily by Wall Street on its ability to maintain incredibly high, stable margins, institutional investors hate this option. It directly impacts earnings per share.
Choice number two, they pass the cost on to the consumer. They protect their margin, but they raise prices. The $1,200 phone becomes a $1,350 phone. But even with Apple's legendary brand loyalty, they are testing consumer demand elasticity.
Right, there is a limit.
In a tough macroeconomic environment where inflation might already be pinching wallets, there is a breaking point. At a certain price, people don't switch to Android, they just delay upgrading. They hold on to their old iPhone for 4 years instead of 3. That extends the upgrade cycle and hurts annual revenue.
And choice number three, which is the most structurally difficult long-term play. They expensively overhaul their entire supply chain to move manufacturing to non-tariffed jurisdictions, like accelerating the move to India or Vietnam.
Which takes forever.
You can't just pick up a city-sized manufacturing hub in Zhengzhou and drop it in Texas or Mumbai overnight. This takes years, costs billions in capital expenditures, requires training a new workforce, and introduces massive execution and quality control risk.
None of those three options, absorbing costs, raising prices, or rebuilding supply chains, is a positive catalyst for the stock in the short term. They all introduce friction. And this is where the psychological pillar comes in. We talked about FOMO with NVIDIA and recency bias with AMD. The psychological trap retail investors fall into with Apple is something behavioral economists call anchoring.
Anchoring is a deeply ingrained cognitive bias. Apple is arguably the most widely owned, widely followed stock on the planet. It is a staple in almost every 401k and index fund.
Oh, totally.
Because of that, millions of retail and institutional investors have built a mental model over the past 2 decades that categorizes Apple as a perfectly safe investment. They anchor their expectations to the historical reality that every time Apple has faced a crisis, Steve Jobs passing away, the iPhone antenna issues, the shift to 5G, they have innovated their way out of it, and the stock has eventually marched to new all-time highs.
So the investor mindset is purely emotional. They look at the drop from 340 to 304 and think, Apple is Apple. I'm reading this on an iPhone. My kids won't use anything else. The ecosystem is inescapable. It always comes back, so I'll just buy more.
The problem with that mindset is that the stock market doesn't have a memory, and it certainly doesn't care about your emotional attachment to your blue text bubbles.
That's a great point.
Markets do not reward past brand loyalty. Markets operate purely as a forward-looking discounting mechanism. They only reward future cash flows relative to current expectations. If structural shifts in global trade policy permanently impair their future cash flow margins, if it simply costs more to make the phone, and they sell slightly fewer of them, the stock must adjust downward to reflect that new mathematical reality, regardless of how great the brand history is.
That is a cold, hard truth of investing. Don't confuse the product in your pocket with the math on the balance sheet. So let's look at how the broader market is mapping that reality on the technical chart. Apple fell from 340 down to 305. Where are the battle lines drawn right now?
The recent area around 302 to 305 has become a highly critical support zone. If you look at the volume profile, buyers have historically stepped in around this valuation. It represents an area where institutional investors feel the cash flow yield is attractive enough to offset the tariff risks.
What does a bullish recovery look like structurally?
If the stock can bounce cleanly off this support level and push back toward the 315 to 320 region, it begins to repair the short-term technical damage on the chart. It shows that institutional money views the trade policy fears as largely overblown relative to the sheer cash-generating power of the services business.
And the downside risk. What tells us the narrative is actually breaking?
If the stock decisively loses that 300 level, if it breaks down through the psychological floor of a major round number on high sustained volume, that signals a major shift in sentiment.
A big shift.
It tells you that institutional investors are becoming deeply defensive. They are likely modeling in a worst-case scenario for supply chain disruption or consumer demand elasticity.
Which leads us to the final verdict on Apple for our framework.
The verdict is hold, with buying interest near strong support rather than chasing rallies.
The overarching theme here is discipline, which is hard with a company you love. Apple remains one of the world's most fundamentally sound, cash-generating businesses in history. But a world-class business does not guarantee that every entry price is a profitable one. You have to wait for the market to give you a price that mathematically compensates you for the political friction of a deglobalizing supply chain.
That perfectly encapsulates the difference between a consumer and an investor. Now let's pivot sharply. We've looked at technology, AI infrastructure, and consumer electronics. Number 4 on our list takes us away from the digital world and plunges us directly into the physical world, where politics isn't just a headwind, it is the primary engine of the entire trade.
We are talking about ExxonMobil. And if Apple is the trade policy stock, Exxon is the pure, unadulterated geopolitical premium stock. It's the ultimate reality check that the physical world still runs on physical commodities.
Let's set the table with the current market data. Exxon is trading around $159.79. But to understand Exxon's price action, you don't look at their internal corporate decisions first, you look at the underlying commodity they extract.
Right.
As of August 12, 2026, Brent crude, the global benchmark, is sitting around $89.63 a barrel, and WTI, West Texas Intermediate, the U.S. benchmark, is at $83.91.
Those are highly elevated, very profitable prices for a producer. And the reason they are elevated has nothing to do with Exxon discovering a massive new oil field. It is entirely driven by the macroeconomic and geopolitical environment. Oil prices have surged due to escalating concerns surrounding the U.S.-Iran conflict, specifically the rising military threats to international shipping in the Strait of Hormuz.
This is where we need to explain the actual mechanics of the global energy market, because it dictates the stock price. Oil isn't just a commodity that goes into your gas tank. It is a primary geopolitical weapon. And the Strait of Hormuz is the quintessential example of a geographic choke point.
Explain the choke point concept in detail, because when I see shipping delays on the news, I think of a traffic jam. But this isn't just a temporary delay, is it?
Far from it. A choke point is a structural vulnerability in global logistics. The Strait of Hormuz is a narrow stretch of water connecting the Persian Gulf to the open ocean. A massive percentage of the world's total global oil supply, millions of barrels a day, must physically pass through that specific, narrow bottleneck. It is the artery of global energy.
So if military conflict breaks out, or even if there are localized shipping threats like drones, mines, seizures, what happens mechanically to the market?
The market reacts instantaneously to the threat of disruption, often before a single drop of oil is actually lost. If a conflict escalates, the maritime insurance premiums for these massive VLCCs, very large crude carriers, skyrocket.
Insurance.
Sometimes the insurance becomes so expensive that shipping companies simply refuse to transit the strait. If that route is choked off, the entire global energy market tightens violently. Supply is constrained, but global demand for energy remains relatively constant. You still need to heat homes, fly planes, and move freight.
Basic economics kicks in. Supply drops, demand stays steady, the price of the commodity rockets upward. And this sends immediate, massive cash windfalls straight to the bottom line of domestic producers who have reserves outside of that conflict zone. Producers like ExxonMobil, who have massive operations in the Permian Basin or offshore Guyana, suddenly see the value of their product jump 15% without having to lift a finger.
And you can see exactly how powerful that geopolitical tailwind is in Exxon's Q2 numbers. They generated roughly $116 billion in revenue, which is up about 42%. Their reported profits were around $14.5 billion.
The profit is huge, but the cash flow numbers are what really jump off the page to me as an analyst. Roughly $23.6 billion in operating cash flow and a staggering $17.2 billion in free cash flow after capital expenditures. That is an astonishing amount of cash to generate in a single 90-day period. They can use that to pay down debt, hike the dividend, or aggressively buy back their own stock.
It is a literal cash machine right now. But this brings us to the most dangerous psychological trap of investing in cyclical commodities. The critical question an investor must ask themselves right now, staring at a $160 stock price, is this: can I safely extrapolate today's crisis-driven oil prices into tomorrow's long-term profits?
I'll play devil's advocate. If I see Exxon printing $17 billion in free cash flow in one quarter, and the news out of the Middle East looks worse every day, my instinct is to back up the truck, buy the stock, and collect the dividends. Why shouldn't I do that? What am I missing?
Because you are fighting the inevitable gravitational pull of cyclicality. Energy markets are notoriously boom and bust. The cycle operates like clockwork, and it traps retail investors every single time.
How does the trap work?
Geopolitical tensions rise, oil spikes. Investors see the massive cash flows, they become euphoric, they convince themselves that this time is different, and oil is going to 150 permanently, and they aggressively buy energy stocks at peak valuations.
Then what happens? The cure for high prices is high prices, right?
Exactly. Or the geopolitical situation simply stabilizes. Supply from other regions comes back online to capture the high prices. The conflict cools down, oil prices normalize downward toward their marginal cost of production. And those exact same investors who bought Exxon at the top based on headline panic suddenly become wildly pessimistic as the earnings momentum evaporates. The stock drops, they panic, and they sell at the bottom of the cycle.
It's a completely different flavor of recency bias. When we talked about AMD, the bias was assuming the line on the stock chart would keep going up forever. With Exxon, the bias is assuming that the current geopolitical crisis will last indefinitely.
People internalize the anxiety of the current environment and project it out to infinity. But historically, geopolitical risk premiums can disappear surprisingly quickly. If the United States and Iran were to reach some sort of meaningful diplomatic agreement tomorrow, or if naval escorts fully secure the shipping lanes in the Strait, that entire geopolitical premium, the extra $10 or $15 a barrel that is currently baked into the price of Brent crude, could vanish overnight.
And if oil falls 15% in a week, Exxon stock will mercilessly follow it down, taking all those extrapolated earnings projections and retail portfolios with it.
Which is why we have to look very closely at the technical context of Pillar 3. Because the chart right now tells a story of aggressive, potentially exhausted buying. Exxon climbed from around 136 at the end of June to approximately 160 by mid-August.
That is a very strong, sustained $24 move for a massive, heavy integrated oil company.
It is. The recent breakout above the mid-150s is a technically important signal. It shows real institutional accumulation. Big funds were adding to their positions. But after a vertical move like that, driven largely by external headline risk and fear, buying blindly at the absolute top becomes exceptionally dangerous from a risk-reward perspective.
You don't want to buy a vertical line. You want to see consolidation.
Exactly. I would much rather see the stock pull back toward its previous breakout levels, maybe test the low 150s, and trade sideways for a few weeks. That technical consolidation demonstrates that buyers remain willing to step in and defend the upward trend, even when oil isn't dominating the front page of the evening news.
So taking into account the massive cash flows, the structural checkpoint risks, the cyclical nature of commodities, and the chart breakout, what is the final verdict on ExxonMobil?
The verdict is BUI on pullback, not on geopolitical panic.
The distinction there is so crucial for our Smart Money USA listeners. If you are buying Exxon because you have done the deep fundamental work and you believe that years of chronic underinvestment in global oil infrastructure means that baseline prices will remain structurally higher for the next 5 years, that is a valid, logical investment thesis. But if you are buying it simply because you watched a scary news segment about the Middle East this morning and felt anxious, that is not investing. That is speculation.
And the market will ruthlessly punish speculation disguised as investing. Which leads us to our final asset of the day. If you thought Exxon was tied to geopolitics, the last company on our list is the absolute pure embodiment of business and politics being completely inseparable.
We are talking about the government contract behemoth itself, Lockheed Martin, currently trading at $597.59.
With Lockheed, we aren't talking about tariffs slowing down consumer goods or export controls limiting commercial chip sales. We are talking about a company whose singular defining customer base is governments.
Yeah.
Primarily the U.S. Department of Defense and allied NATO nations.
Right. They don't sell iPhones or graphics cards to the general public. They sell fifth-generation fighter jets, advanced missile defense systems, military satellites, and munitions. Therefore, their future revenue is directly mathematically correlated with global military modernization cycles and international threat perception.
And right now, the global threat perception is elevated across multiple theaters simultaneously. We are seeing a massive structural shift. Europe is actively rebuilding its military capacity from the ground up after decades of underinvestment.
Yeah.
The United States is aggressively spending to replenish domestic missile inventories that have been depleted by foreign aid. The Middle East remains highly unstable. And there is a massive urgent push for advanced next-generation missile defense technology to counter new threats.
You can see the direct, fundamental result of this environment in their Q2 2026 numbers. Let's rattle these off because they are incredibly robust for an industrial company. Sales increased 11% to $20.1 billion for the quarter. Net earnings reached approximately $1.8 billion. They generated $2.9 billion in free cash flow.
Those are fantastic trailing numbers. But in the world of defense contracting, the quarterly revenue is just a look in the rearview mirror. The single most important metric you analyze is the backlog.
And the backlog number they reported is absolutely staggering, $230 billion.
Let that number sink in. $230 billion of future, contracted, legally binding business sitting on the books, waiting to be executed.
Plus, they reported around $65 billion in entirely new orders just during that one quarter. And management felt confident enough in the pipeline to raise their full-year outlook, projecting approximately 8% sales growth.
This is why analyzing a defense stock requires a completely different fundamental framework. You are not just buying today's earnings, you are buying visibility into future government appropriations over a multi-year cycle. And Lockheed is aligning its internal R&D perfectly with the Pentagon's future goals. For instance, they just announced a multi-million-dollar internal investment aimed at developing a modular payload delivery system for hypersonic weapons.
That's a great example of mechanics. Lockheed isn't just building the missiles anymore, they are building the entire delivery ecosystem, making themselves the irreplaceable operating system of the Pentagon's modernization push.
Exactly. They are positioning themselves to be the prime contractor for the next decade of warfare technology.
Okay, so the fundamentals are flawless. The backlog guarantees years of revenue visibility. The geopolitical catalysts are literally on the front page of every newspaper in the world. I have to ask the obvious question that every retail investor asks when they look at this sector. With wars on the news every night and a $230 billion backlog, shouldn't Lockheed Martin be an automatic, aggressive buy right now for any portfolio?
And that perfectly logical question leads us straight into the final and perhaps most subtle psychological trap of the day: headline-driven investing and the ruthless efficiency of market pricing.
I want to understand the trap here, because if I see geopolitical conflict, I feel anxiety, and my brain creates a very simplistic logical equation. Wars are happening. Governments must buy weapons during wars. Lockheed makes the weapons. Therefore, Lockheed's stock must go up from here. It sounds perfectly rational. What is the flaw in that logic?
The flaw is ignoring the efficient market hypothesis. The stock price does not exist in a vacuum, sitting there static, waiting for you to turn on CNN and realize there is a conflict. The current price of $597 already incorporates the collective expectations of millions of analysts, high-frequency algorithms, and institutional investors who study global conflict for a living. If everyone knows that defense spending is rising, and everyone can clearly see the $230 billion backlog in the public filings, that information gets priced into the stock months or even years before the government actually cuts the check or takes delivery of the aircraft.
So the stock moves on the anticipation of the contract, not the execution of it. By the time I read about the $65 billion in new orders, the big money has already bought the stock in anticipation of those orders.
Precisely. And we can see this play out clearly in the technical chart. Lockheed has already experienced an explosive, sustained move. The stock was sitting around 502 at the end of June. By late July, it had climbed above 580, and now in August, it has pushed above 600.
$100 a share in roughly 6 weeks for a massive defense contractor. That is not normal volatility.
That is a massive valuation adjustment in a very short period for an industrial company that doesn't usually move like a tech stock. So, as an investor looking at the asset today, the question isn't, is Lockheed Martin a fundamentally good company? We know it is. The question you must ask is, how much of the good news and how much of the geopolitical fear is already fully absorbed into this $597 share price?
What are the technical battlegrounds we should be watching on the chart to tell us if the momentum is fading?
The chart remains undeniably strong. It is holding its recent gains well above the June levels, which is bullish. We are looking at recent support established in the high 570s to low 580s, but right now, The psychologically massive 600 level is the major battleground between buyers and sellers.
A nice round number always creates friction in the market. It's human nature.
It does. If the stock can mount a sustained, confident move above 600, backed by strong institutional volume, it could signal that the broader market believes earnings estimates still need to be revised even higher based on new defense budgets. However, a failure to hold around 600, followed by a breakdown below that high 570 support level, could be the market signaling that the momentum trade is exhausted. It would mean the good news is fully priced in and the smart money is taking profits.
Which brings us to the verdict on Lockheed Martin for the everyday investor.
Hold EBA or BUY on pullback.
The takeaway here is profound. You cannot chase a defense stock simply because the evening news is frightening. The fundamentals are strong, the backlog is extraordinary, and the political environment is obviously supportive of their business model. But buying after a 20% vertical spike based on headlines is a recipe for stagnation. You are paying peak prices for peak anxiety.
Which brings us to the bigger picture. We have just completed a deep dive into 5 of the most important, structurally critical companies in the American market: NVIDIA, AMD, Apple, ExxonMobil, and Lockheed Martin.
And here's the synthesis, the review of everything we've just discussed. Out of those 5 incredible, globally dominant companies, not a single one received an unconditional, aggressive BUY rating today.
And that is completely intentional. This is the core lesson of the 4-pillar framework we use here at SmartMoney USA. Investing is not a shopping list of exciting companies you read about in a magazine. The purpose of deep analysis is not just to find companies with cool products or massive revenue. It is to ruthlessly, logically identify the difference between 3 distinct concepts: a good company, a good stock, and a good price.
Those 3 things are not identical. A good company can be a bad stock if the expectations are mathematically absurd. A good stock can be a bad price if you buy it at the absolute peak of a manic news cycle driven by FOMO.
Let's unpack how an expert investor stacks this 4-pillar analysis in the real world to avoid those traps. You start with the environment. Pillar 2, politics. This tells you what the rules of the game are, and more importantly, what external forces could suddenly change those rules. Tariffs, export bans, defense budgets, shipping lane security.
Then you move to Pillar 1, fundamental analysis. That tells you how those political rule changes will mechanically affect the company's balance sheet, their margins, and their future cash flow generation.
Then you apply Pillar 3, technical analysis. The chart isn't magic. It is simply a visual representation of how the collective market is actively reacting to those fundamental changes in real time. It shows you where the big institutional money is entering and exiting, where the support levels are, and where momentum is breaking.
And finally, the overarching element, Pillar 4, psychology. This tells you why retail and institutional investors are making predictable mistakes in their reactions, why they're buying at the top due to recency bias or selling at the bottom due to panic.
When all 4 of those pillars point in the exact same direction, when the politics are favorable, the fundamental cash flows are expanding, the chart is breaking out of consolidation, and the broader psychology is still skeptical rather than euphoric, that is when your investment thesis is at its absolute strongest. That is when you deploy capital aggressively. But when they disagree, as they do with almost every stock we cover today, that is when you must slow down, exercise discipline, and wait for your pitch.
So forcing you to put your analyst hat firmly on, I want your definitive ranking of these 5 stocks based purely on this 4-pillar combination of business strength, political catalyst, and the current market setup as of this moment in August 2026.
All right, here is the definitive ranking based on the current risk-reward environment. Coming in at number 5, AMD. The underlying macroeconomic opportunity in AI is enormous, but the toxic combination of sky-high expectations, massive chart volatility, unproven execution against a monopoly, and the same geopolitical headwinds makes it the most dangerous setup of the group right now. The risk of capital loss is too high.
Moving up the list.
Number 4 is Apple. It remains an absolutely extraordinary business with unmatched consumer loyalty and cash generation. But the looming threats of trade policy impacts on their supply chain, combined with a demanding valuation, require patience. You hold it if you own it, but you wait for your pitch on support before adding new capital.
The middle of the pack.
Number 3 is ExxonMobil. It has a uniquely powerful geopolitical catalyst right now, with the Middle East tensions driving massive free cash flow. But it is dangerously tethered to the inherently volatile cyclicality of global oil prices. The risk of the geopolitical premium vanishing overnight and crushing the stock keeps it firmly in the middle of the pack. You buy it on structural pullbacks, not headline panic.
The runner-up.
Number 2 is Lockheed Martin. They boast an exceptional $230 billion backlog and are operating in an incredibly strong multi-year defense spending environment. The underlying business is a fortress. The only reason it isn't number 1 is that the stock has already absorbed so much of the good news in its recent vertical sprint to 600. You need a pullback to create a margin of safety.
Which leaves the undisputed king of the current market at the top.
Number 1 is NVIDIA. Despite the extreme valuation, despite the very real geopolitical headwinds with China export controls limiting their total addressable market, it remains the absolute strongest structural growth story of the 5. The AI infrastructure build-out is a generational shift, and their software moat is unparalleled. However, owning it demands supreme discipline regarding valuation and the psychological fortitude to stomach $30 swings in a matter of weeks.
And that brings us to the ultimate takeaway for you, the listener. We started this deep dive talking about how frustrating it can be when a stock's movement doesn't seem to match its earnings or the headlines. But the truth is, the market has already seen the exact same terrifying or exhilarating headlines that you have. Your edge as an investor does not come from trying to act on the news first. You will never beat the high-frequency algorithms. Your edge comes from interpreting the news better than the herd.
The next time you open your brokerage app and look at a stock, stop asking yourself, which stock is going to go up today? Instead, force yourself to ask a harder series of questions. What is the broader market currently assuming about this company's future? What specific event could prove that assumption mathematically wrong? And what price am I willing to pay for taking on that uncertainty?
Because if you can answer that, you aren't just reacting emotionally to the market anymore, you are actually analyzing it. You are protecting your capital. Just remember, as we wrap up today's deep dive, everything we've discussed represents analytical views, not personalized financial advice. The geopolitical landscape and market psychology can shift overnight, so always assess your own risk tolerance before making any moves. But it leaves you with one final thought to mull over. If the market prices in the evening news before you even turn on the TV, what quietly unfolding story is the market completely ignoring right now?
That is the multi-billion-dollar question.